So this was the quiet under the scenes. Last week we talked about the Trump visit to Japan before the ASEAN or APEC. I think it was the economic summit in South Korea between basically all of the nations around the rim of the Pacific Ocean, from Southeast Asia, Oceania, North America, South America, all the above. I don't know that Scott Bessent was there, but we caught a headline under the surface that kind of went unnoticed under the big picture, right? The big ones that got people's attention. The first stop in Japan, Trump visiting new Prime Minister Taikichi, being gifted Shinzo Abe's putter, and then going to South Korea, meeting Xi face to face. That was the 12 out of 10 we talked about last week. I don't think we got this last week in the headline, but in our discussion. But we saw a comment from Bessent urging the new Japanese government that just formed to give its central bank, the BOJ, he called it policy space, right? And what does that mean, right? It really, what he's asking for is let the central bank do their job to fight inflation, right? And what does that mean in effect? If you go to the next chart, so CPI in Japan, just consumer price levels, they've been above the 2% target, just made up target for central bankers across the world. They've been above that for, I think it's been 41 months in a row, is what I heard. Yeah, it's been over 3 years at this point of above target inflation. And just keep in mind, for context, if we zoom this chart out since the Nikkei collapsed and the Japanese just speculative bubble of the 1980s rolled over in the I think it was 1990 and 1991, that turnover of that year when it peaked. You've been looking at a deflationary trap. They call it like the balance sheet recession that Japan was in for 40 years. And everybody knows the situation, the demographics of Japan, et cetera. We've been in this era now where inflation is running above target, which is telling you something, right? That old era is over, and this environment where BOJ policy gradually ramped up in its experimentation, when they first found themselves in this rollover in the 1990s, they tried lowering interest rates, like all the classic steps, and then they actually said, "Oh, we got to get experimental here." And this is where you actually saw the invention of QE, right? Central bank buying assets on its balance sheet. Starts with government bonds, but it expanded into like all financial assets. Like it includes equities as well in their QE policy. So whatever you all think, like the U.S. did, and all the memes of Ben Bernanke, Janet Yellen, Jerome Powell with the money printer, like the Japanese central bankers did that and more. It's like they're the Michael Jordans of central bank easing. But what you're seeing now is that easing, same way once the US did it, once other countries did it, the countries that tapped that policy button the hardest in COVID in 2020 saw the inflationary effects and like materializing throughout 2021 and then peaking in 2022. And the US, to rein it in, had to undergo the tightening cycle that we're just now 12 months into loosening up and going through the aftermath of that process. But what I wanted to get across here, everybody in the US, you see a lot of doom posters expecting monetary policy to operate in basically the same thing we've been used to in the post 2008. I'd say the Ben Bernanke response that was copied by Janet Yellen, one for one, essentially, and then leaned into by Jerome Powell. That's just where the FOMC, the Fed, the organization was at the beginning of Powell's term. But I think a lot of the commentary right now on X and social media, the discussion around what's going on in credit markets, what's going on in interest rates, cuts are here, we're ending QT, et cetera. We have a tendency to assume each cycle is going to look like the policy cycles of recent memory, because that's all we have, in our lived experience. But I think there's a risk that the underlying dynamics are different, right? We have a new boundary constraint, like especially from the U.S. situation, and I'll go into Japan as well. So we learned if we just do QE and we print into oblivion, and fiscal fills in a hole to try to pull the economy up, off of life support in one of those type of situations. There are new like constraints to deal with, supply chains,
I see. Yep.
dollar exchange rates, all the above. So if we just keep pressing that button, we went from not getting a certain, output in the 2010s just because we were coming out of such a deflationary hole. Pushing on a string is the term that was used. If you can remember the 2009, 2010, economics and finance discussion. We learn now that the string is like 2020. It's not floppy anymore. You push it, you're gonna run into the constraints, right? Because your other economic inputs, um, your supply of labor, your resource, access and supply chains, those are all kind of, you're at the boundary of those. So you need to funnel investment towards pushing those things out to improve your economy's ability to deliver growth in the future. So what do I mean here? What am I getting at? Everybody's kind of posting charts of like the RRP facility being drained or something like that, thinking, the QE is coming right back. When you hear Treasury Secretary Bessent make the case for the new Japanese government and the coalition to appeal to them to allow their central bank to actually fight the inflation, allow sovereign debt interest rates to rise. And this, if you look at yield curves, this is what they're doing. It's going to be okay, right? Same thing that happened in 2022. Like he's saying, like, this is the direction we actually want you to go. And in this world where you've got this new U.S. coalition being built up in real time, we talked about this. You got the U.S. now taking over the flag, like new management of, not just the country, as the country's under new management. We talked about that, but kind of the business franchise, the old Anglo-Dutch cartel, the Commonwealth, right? The British Empire, all of that. In my opinion, U.S. is now leading that economic, organization. We've taken over the flag at the front of the movement, and we're adding in business partners around that, right? So Argentina example, Japan clearly in the fold after what we saw in the last week or two. And what you're basically saying, if you're Scott Bessent, is like, let rates come up, it's going to be okay. And within the partnership, Japan with the U.S., led as the kind of the hub and spoke of this new supply chain network, trading infrastructure, all of that. It's actually going to allow Japan to address their inflation problem, which has now become, the flip. What used to be a deflationary collapse, now it's turning in. The market signals are, no, you're early in the process of the new regime, right?
Right.
So Bessent is saying, let interest rates come up. What that's going to do, it's going to create problems. So you got to do this slowly at first to make sure, because not everybody in markets has, no, they can't change their positions and their strategies just on a dime. It takes time for them to adjust. And if you let the Japanese yen, potentially strengthen, which would address the inflation problem, and allow interest rates to rise or bonds to sell off. Alternatively, everybody who's taken out low interest, zero interest, negative interest rate loans in the Japanese yen and used it to finance, buying other assets, you don't want to risk blowing those up as what like we saw last August, right? Remember that yen carry trade when it started in the headlines and everybody suddenly became aware of it. What you're basically getting from Scott Bessent is like an appeal. Let your bank, your central bank, fight this problem. And what this is actually going to do, you've got this stockpile of liquidity. Like think about this from like where is the dollar liquidity going to come from in for the next reflation? I think in my perspective, I've talked about this in the past. Ideally, it comes from reflation or releveraging of the private sector in the U.S. economy. So households, businesses, maybe there's well documented home affordability issues in the U.S. So young generations just can't pencil out the numbers to make a home mortgage work for them. Getting that lined up will be a big part of it for that liquidity creation that needs to happen. Ideally, the reflation in the U.S. economy and the financial system. But another piece, you've got a massive stockpile of liquidity here in the BOJ, and this is what Scott Bessent is saying. Allow your central bank to fight the inflation problem. Give them the policy space, which would mean you see at this tail end the BOJ's balance sheet, which goes up to this is in millions of yen, 100 millions of yen on the y-axis. And they're at 7 million, 100 million. So I think that comes out to like 700 trillion yen, which at about 150 yen per dollar. I think it's something in the range of about 4.75 trillion, call it, just stockpile of liquidity that could flow into just global FX. So what would happen here? Central bank, when the BOJ allows interest rates to rise, what they're going to do is essentially it's going to be a QT runoff, similar way that the U.S. when we were in a QT environment from March 2022, ending on December 1 of 2025, coming up, less than 30 days from now. The technical way that happens is central bank doesn't roll over maturing principal maturities and interest payments into more purchases of government bonds, which means if your fiscal policy wants to continue running deficits, the private sector has to step in. And that's where, the lowest marginal provider of capital, right, the lender of last resort is no longer there. They're stepping back, which means interest rates are going to clear higher, right? So what does that mean? Higher interest rates in Japan means more capital is pooled into the currency itself and its short-term bond market or credit markets. And then what that will actually end up doing is strengthening the yen, which also simultaneously will increase the private sector's purchasing power to pull in imports at just improved economics. So if you think about this, higher interest rates, strengthen the yen, actually equates to more better affordability, lower prices for the Japanese. If you think about what do the Japanese import, sort descend. Japan is an energy poor, just natural resource poor kind of island chain economy. Sizable, it's large, highly skilled population, very educated workforce, all of the above. What they don't have is natural resources. So what this is actually going to in practice do, the energy commodities that the Japanese economy needs to consume, households, businesses, etc., manufacturing inputs, raw materials, those will all get more affordable in Japanese yen terms, which will kind of balance out the recessionary or the growth slowdown dynamics of higher interest rates. What this is actually going to do in the global economy is encourage Japanese imports, which if you look at this on a bespoke trade partner relationship, Japan to the US is the key one, focus here. Japan would be incentivized to import more, and then its exports would be less favorable with a weaker dollar. But on the net, this is also helping the U.S., right? Because it's lowering its own current account deficit. That is causing a lot of the dynamics behind the fiscal situation, the monetary situation in the U.S. So what this is actually doing is two partners getting on the same page, working together.
Yep.
Scott Bessent is saying, trust us here. It's going to be okay. We have your back. You can do the trust fall. It's a very scary thing for a central banker, or even more so for a politician, because if this doesn't work, you're looking at financial losses hitting your electorate. They're going to vote you out. All of the above. So you need some confidence to let your central bank do its thing. So what I would say, all these charts you're seeing, where is the liquidity going to come from in the U.S.? A lot of it's just going to come from lower interest rates, and then the reflation that may or may not come. We don't know yet. From the private sector in the U.S. is ideally where they want it to come from this round under the new regime, since we're out of the post GFC, 2008 to 2022 policy window, right? We're in a new era. I think the other arm of that, and this is going to be a very powerful effect that I think is not fully appreciated, is what's going to go on here in Japanese monetary policy.